makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Krenny in Dubai, and here's what's coming up on the program today. The Fed is poised to hike interest rates to the highest level in 22 years, an 11th increase since early last year. US futures in European stocks are mixed. Banks bonanza, UniCredit rises as profits surge. Deutsche and Santander beat estimates while Lloyds misses. Plus, the NatWest CEO, Alison Rose, resigns following a row over the way the bank closed accounts held by the politician turned pundit, Nigel Farage. There's a skittishness to these markets, there's a fragility to the European outlook, and the heart of Europe is down. France is blood red, but what you have a story here is, of course, demand for credit is reducing. Louis Vuitton, the aspirational wealthy, are not spending as much. Is today the day when you face reckoning in terms of the rate story around the world from the Federal Reserve? There's one stock which is absolutely resplendent in the United Kingdom. Anna has just finished a conversation with the CEO of Lloyds. There's a fragility to the UK, to the economy. House prices are down, but he expects those house prices drops to end next year. Miners are also lower. You're seeing Rio Tinto profit slide and cutting the dividend. So that boom bonanza of the commodities boom in the reopening of China just has not played out as expected. I want to show you Rolls-Royce. They raised the guidance on their profit on surging travel demand. They've got to repair those engines. That's the point that Anna made just before we came off air. Look at this. The first half year profit will be £680 million, twice the estimate, and the full year will be materially above expectations at 1.2 to 1.4 billion. And the defence business, there's money in war. Defence business will report a 38% increase in operating profit to Rolls-Royce, the engine maker, not the luxury car maker. We're going to keep an eye on tech. We'll check those prices a little bit later on. Across the assets, the field of dreams may be shattered today. We're expecting what kind of a hike? 25 basis points, a 22-year high from the Federal Reserve. However, will it be a hawkish hike or a dovish tone and intonation from Powell? There will be no new dot plot. CPI in Australia comes in a little bit lower, putting the pause factor back on the table for Australia, down 0.3%. NYMEX crude drifts off by 1/8 of 1%. We wait for the inventory data later today. And the euro, what the heck? Why not? Because if it's a hawkish hike from the Fed, it may imbue a sense of revival in the dollar and perhaps injurious to the euro. Let's see how the day plays out. As I say, the main course of the day is the Federal Reserve policymakers poised to hike interest rates to the highest level in 22 years. Joining me now is Eddie van der Belt. He is our Markets Live team. Fine. One more and done. But then can you explain to me why the market thinks we're going to get 130 basis points of a hike from top to bottom by the end of next year?
Yeah, look, so this meeting is baked in, as you say. We know what's coming. We know what the Fed's going to do. There's little surprise that they're going to give us. But looking beyond that, the market is looking at something like a 50% chance that there's one more hike coming in November. And then beyond that, the market is expecting cuts. And the market is expecting cuts because they think the Fed has already gone too far and won't be easing early enough to take the pressure off the economy, and that we're going to start to see a U.S. recession, as early as late this year or maybe next year. Now, there's a real question about that, and also about just how much other central banks, like the ECB, will be able to resist a Fed that turns more dovish later in the year. Because at the moment, the expectation is that the ECB remains quite hawkish, remains, keeping the fight on inflation. But with its economy softening it as well. I think there's an awful lot to play for at this meeting.
What do you trust more? Because I see two very different messages coming towards me. I've got consumer confidence at a 2-year high in the United States with a Philly Fed saying, oh, pay me more, pay me more, pay me more. And then I have the New York Fed, which I'm supposed to venerate in front of the altar of the New York Fed and go, wow. Recession risk is at a 60%, the 40-year high. Who do I venerate the most, the House of Fed or the House of Consumer?
Yeah, the consumer numbers were quite a surprise. And the consumer has been quite strong through all of this. Now, when we start to break down those numbers, when we look at like PMIs and so on, we're seeing the weakness in the economy mainly coming from the manufacturing sector, and the services sector still relatively resilient, even as we start to see that number creeping closer to 50 and the contractionary levels below that. But I think there's one other thing that I think that we need to take into account, and that is instability in the banking sector. Now, the Fed, the only time that I've really heard Chairman Powell sound quite nervous this year was back in March when we had the big the big instability in the banking sector. Yesterday there was with PacWest, we saw the share price fall significantly, talk of the takeover there. And I think if we see a return to those kind of conditions, I think it would shift the Fed's narrative very quickly, and we will start to see cuts follow sooner rather than later.
Yeah, it's almost like it's bubbling below the surface, but yet, the overall index is just pumping away with the concentration in tech. Eddie, thank you very much. Let's see what the evening brings for us. That's Eddie van der Walt, our Markets Live team. So the International Monetary Fund, they've raised the world growth forecast for this year to 3.8%, to 3%, up from 2.8%. That they projected in April. Now, the fund's chief economist told Bloomberg that inflation is still a drag.
The biggest threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit. I mean, there was quite a bit of resilience in the global economy, but especially in the first quarter. But, the momentum is slowing down. And this is why, at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth.
Aneeka Gupta is our guest this morning, Director of Macroeconomics Research at Wisdomtree. So the IMF, many people deride the IMF as being late to the advisory party and the upgrade to growth. But Aneeka, I said to Eddie, I venerate the House of Fed in New York, which says the probability of a recession at 60% at a 40-year high. Or do you put your trust in the consumer, where consumer confidence is at a 2-year high? Who's right?
A very good morning, Manus. I do put my trust in the consumer because that's the part of the economy that has been most resilient, and that has been, hiding the disparity between the, strong activity data in services amidst the, weakness that we've seen within manufacturing. So I think what did come to light in the IMF report is they have seen some strong economic momentum coming in from most of the developed parts of the economy. That's clearly been quite helpful, but that there is a clear disparity that we're seeing between manufacturing and services, and rightly so, because the effects of monetary policy are slowly being filtered into the economy, and that transmission is taking place, and that's what we're seeing play out within manufacturing.
And I think that was demonstrable yesterday when we had the EFO president with us, and that huge drop in in demands from corporates, from the banks, a record drop in demand. When you look across to the USA, rates we expect to hit a 22-year high tonight. Do you think it's prudent that Powell indicates pause, or must he go for the hawkish hike to sustain his optionality?
Well, I think that he's most likely to go for more of a hawkish hike. And the reason for that is, on one end, if you look at economic surprise indices, the US has been the most resilient. So when you compare the US to Eurozone and China, the US economic activity surprises have been doing a lot better. So the US is faced with a situation where they have been bringing down inflation. It's around 3% now, much closer to the Fed's target compared to the Eurozone, the UK. And that is coming against an economy that's fairly strong. So yes, as we move ahead, we're likely to see the US economy slow down. But they have made progress on two fronts. The growth is fairly steady. Inflation is coming down. And hence, I think, he's going to keep it open to being quite data dependent based on how the progress moves as we move into year end.
Now, look, central banks never talk about currencies, and they deflect and rarely refer to them. I look at the dollar, it's obviously retraced significantly in this first 6-7 months of the year. Do you think that that's, as it were, doing some of the lifting against 5.5% rates for the Dow, the broader bulwark of the United States of America? It's on a winning tear, one of the strongest that we've seen for a number of years.
It's a very interesting point you've raised, Manis, because what we have been seeing in the Eurozone is the strength of the euro versus the US dollar is now becoming quite an important concern for the doves on the European Central Bank. So I think that is another factor that they will take into account, as it's clearly going to make imports coming in a lot more cheaper. Yet at the same time, it's going to make their exports, which is very important for the Eurozone economy, a lot more expensive. And that could be an important headwind for growth. So I think the ECB is taking note of that. We have seen recent talk of the doves paying a bit more closer attention to euro strength.
OK, well, we'll pick that up in just a moment. We're going to continue the conversation on Europe. And as you say, perhaps a boost for Europe. Let's see what the dollar's drop has done elsewhere. Aneeka, stay with me. Aneeka Gupta, Director of Macroeconomics Research over at Wisdomtree, our guest this morning. Coming up, European banks, they post their earnings. We'll bring you the very latest on the likes of Lloyds, Santander, Deutsche Bank and UniCredit right here on Bloomberg. We've had a slew of bank earnings this morning. Lloyds posting a miss. Deutsche delivering a beat. Lloyds, of course, the CEO was with Anna just a few moments ago saying the fragility in the UK is going to limit growth. Deutsche is down by 0.6%. I mean, if you think about it, and you've got UniCredit. By the way, UniCredit up 1.7%. They've raised the full year target for the year. They are the top performing stock in the banking sector, up by 70% this year. Santander, of course, up 26% as well. Deutsche did a buyback, but there's just that lack of belief in the velocity for the rest of the year. Let's get to Bloomberg's Andre Jussen van Vieren. He is with us on the bank. So Deutsche, good set of numbers ahead of the estimates, and yet the stock's down. Why?
Morning, Manis. I think as you say, it was a good set of numbers. We had the 450 million euro buyback that Deutsche released yesterday with promises of more to come. We've seen fixed income trading revenue that were down, but still better than what was expected, and also ahead of most of Deutsche's rivals on Wall Street. So yeah, as you say, why is there that lack of belief? I think maybe two items to flag. Expenses came in higher. That was due to redundancies and litigation, and also there's also that sense that the initial boost from higher interest rates are starting to wane.
Yeah, I mean, Santander has the breadth of reach, haven't they, into Brazil and Chile. Andre Orchel must be the smiling man of Europe. I mean, can you imagine his options and what they are worth? To be the CEO of UniCredit. What conclusion do I walk away from today?
I think, first of all, maybe just first, if I look at Deutsche Bank, for instance, again, I think what will be interesting is to see his guidance just on how, on interest margins. We've already seen that being flagged by Deutsche, but if you look at sort of like the likes of Santander, a retail bank, it's just to what extent are the tailwinds from rates holding up? In the case of Santander, we've seen that they're still benefiting to what extent, to a big extent. But we may be looking at guidance about whether those margins may be closing, You know, to what extent banks will need to pay more for their deposits, and also to what extent demands for loans are falling, and you know, provisions that needs to be made.
Well, that demand for mortgages imploding yesterday and demand from companies under pressure. Andre, thank you so much. That's Andre Friefin, our resident reporter on banks. And Deutsche Bank weathered the trading slowdown better than analysts had expected. The CFO, James von Moltke, spoke to our very own Oliver Crook on the earnings and the outlook for Germany.
Sort of a mixed picture, as I said earlier, but in part what I mean there is Germany and Europe more broadly has been somewhat stagnant in terms of its growth these past several quarters, sort of at around zero. We do expect that to be a little better in the second quarter, but what you're seeing is the effect of certain sectors, so building, for example, and real estate being in a recessionary territory. Other sectors like services, you know, growing quite strongly. So there's a mix going on. And to your question, you know, what is the dynamic going forward of recovery in those areas that are recessionary? What's going to happen with sort of the industrial order books and the export market? All of those things are in play, but I think the conditions are in place to see sort of steady growth starting, you know, either late this year or into 24.
And just very quickly, because we have not much time left, when we just think about the balance of risks for clients, what are they most worried about now? Originally, you know, is inflation, then recession, then kind of geopolitics. What do you think is the kind of guide right now is preoccupying?
Look, I think geopolitics is front and center. I think, as I say, I think the direction of rates probably more clear. People are getting more comfortable with the direction of the economy, and that really leaves sort of geopolitics as the big unknown that we're dealing with. So as more of these clouds begin to clear, as I say, the conditions are there for a growing economy and a normalized rate environment, which should be good for the banks.
Deutsche Bank CFO James von Moltke there speaking to Oliver Crook. Aneeka Gupta is my guest, Director of Macroeconomic Research at Wisdomtree. Yesterday, 24 hours ago, I brought our viewers this chart, the change in credit demand for residential mortgages and demand for credit from companies. How fragile a moment is this for Europe?
It is a difficult moment, Manus. We're seeing activity indicators are coming down. You know, just this week we've seen PMI data for manufacturing, especially in Germany, being quite weak. But I will, you know, if you recall, at the turn of this European rebound cycle that we did get, we had PMIs coming down to extremely low levels. So I think we would discount some of that information coming out from the PMI data and give a bit more credit to the hard data that's coming in for the Eurozone economy. Even if you look at, you know, the European consumer is still sitting on excess savings that haven't really been wound down as it has been by the US consumer. And in addition, I think another factor that's you know, boding well for Europe is we are seeing inflation coming down. And from an income perspective, that should also be beneficial for the European consumer.
Aneeka, let's see how we bear up through the second half of the year. That is Aneeka Gupta, Director of Macroeconomic Research over at Wisdomtree. Coming up in the show, Danone sale beat estimates. The shares drop as concerns remain over the company's turnaround plans right here on Bloomberg. Welcome back. Danone topped its estimates. The shares, however, are lower this morning. We've got concerns around the company's turnaround plan. The French yogurt maker is taking a €200 million impairment on its assets seized in Russia. Let's bring in our reporter. It's Dasha Afanasieva. Dasha, so the results, they just didn't do as well as Unilever. And in this earnings season, you gotta deliver.
Absolutely, and especially if you have an environment where you are increasing prices by a lot and you're setting your, your sales target at reasonably low, you've got to deliver, and you've got to show that particularly the biggest division, which for Danone is the yogurt unit, is experiencing a turnaround. But what actually happened is volumes in that division fell more than 3% in the quarter, which really asks questions about Danone's ability to persuade the consumer to pay premium for these branded products instead of just buying your regular supermarket yogurt.
Yeah, it's convincing us. I mean, the price of yogurt here, I'd make you cry if I told you the price of a pot of yogurt. Impairments in Russia, it's costly getting out of it. Briefly, the size and the impact.
So there's nothing too new in the sense that we already knew that they take an up to €1 billion impairment. But I think it's just a real headache because Danone's now saying, you know, that we do actually own this division that's been seized from us temporarily. There'll be a legal ramifications when they sort of try and get damages back, I imagine. And in the meantime, they're trying to stay in contact with their 8,000 staff over there, and it's a really difficult situation.
It's tough. Indeed. Dasha, thank you so much. Dasha.
Thank you.
Afnaftsieva, our reporter on the latest from Danone. Tech earnings. Are you bid or are you offered on Alphabet or Microsoft? The Fed is poised to hike interest rates to the highest level in 22 years. It will be the 11th increase since early last year. US futures and European stocks remain mixed. Banks bonanza UniCredit rises as profit surges. Deutsche Bank and Santander beat estimates while Lloyds misses its mark. Plus, NatWest CEO Alison Rose resigns following a row over the way the bank closed accounts held by the politician turned pundit Nigel Farage. A very good morning. It's The Pulse. I'm Manish Krani in Dubai. It will be a pivotal week for tech stocks. Alphabet stock, let's just check in on how we're trading pre-market because apparently we are still Googling. Alphabet shares are up on some news that ad trends are doing quite well. So you've got Alphabet up 6.63%. The cloud unit had its second profitable quarter, $395 million. That's more than the market had anticipated. We are Googling. Of course, they own Google rather than ChatGPT. And you've got Microsoft. Now, Microsoft, on the other hand, sees a deceleration in their cloud demand. So somebody's winning the battle for cloud. We'll ask Aggie Cantrell in just a moment why the divergence between the two. Those are your pre-market checks. Shall we get to Aggie? I know that there is a little bit of breaking news, Aggie. I know you love an apparel spritz or a light Negroni. Shall we do that just before we talk about tech? Campari, first half sales, 1.46 billion. Pretty much in line with what the market had expected. Yes, there are veteran Negroni drinkers on this show, and there are veteran apparel spritz drinkers. So we'll bring you more on Campari in just a moment. The resident Italian is out. Ms. Lacqua is somewhere on a beach in Italy, I understand, probably with a Negroni in hand. Never too early for a Negroni. Let's talk big tech. Aggie is patient. She's there. Aggie Cantrell. Talk to me. What's going on with Alphabet and their earnings? I mean, the cloud is doing fine, and apparently we're Googling.
Yes, so with the cloud first, they turned a profit for the first time last quarter in this business, and that seems to still be a sustained thing. That wasn't just a fluke. The Google Cloud is still behind Azure, behind Microsoft, and behind Amazon in terms of its sales, but they do seem to be actually building a really strong business there and managing to generate a profit. But also, what is really interesting to me is the fact that all of this noise about how Google is not going to be able to stand up to the potential of ChatGPT and the investment that Microsoft has made in OpenAI and applying that AI search into its platform Bing, that's not really holding up. When it comes to advertising spend online, Google search is still the core focus. Google search is still dominant, and that is still the focus for this big tech company.
And then Microsoft, on the other hand, I think the word that we're using is tepid sales growth for the quarter, and the company ready to cash in on its AI investments. And I think BI said, look, it's actually better positioned than other cloud providers to monetize. Why?
Yes, exactly that reason. Microsoft has made this play. They were really the early initiators of this original AI hype. When they put a 10 billion investment in OpenAI, that was their move that they said was clearly part of tying these AI capabilities into their suite of tools, into their Microsoft tools, and also into Azure, into their cloud service. But when we're seeing the initial cloud growth, that does, as we have referenced in our stories this morning, we're talking about tepid sales. It doesn't mean that they're really struggling. It just means that maybe they really haven't tapped into the full potential of this AI investment in this current quarter. But there does seem to be a likelihood that they will be able to gain that investment going into the following quarters this year. And so it's really a longer term play. And I think that that's what people were wanting to know more about when going into these earnings is, okay, you made this massive investment. Now, when are we actually going to see a return on that?
Aggie, thank you very much. Aggie Cantrell there with the very latest on the tech earnings. And of course, that it comes down to the breadth of the market. The rally in the S&P 500 and in the NASDAQ being driven in large part by a small and coveted group of stocks. Just to recap then, Campari, first half sales coming at 1.46 billion. That's pretty much in line with what the market had expected. I think, however, what you have here is just a little bit of an initial reaction. Maybe there's disappointment that they didn't just deliver a little bit more robustly than was originally anticipated. So we keep an eye on Campari. And we'll come back to that in just a moment. Now, if you are in the mood for a luxury watch, we track them. We keep an eye on them. We've actually got the 60 most traded watches of the top 10 brands. And what you are just seeing is, well, this is the export chart in terms of what's coming out of Switzerland. They just can't keep up with the demand, really, for Rolex, Patek Philippe, and Audemars. So what we are seeing is 60 of the most traded watches in the world. Prices are actually down by 5%. That's the point that we have here. And we know from Louis Vuitton, aspirational luxury is under pressure. So you can see there the exports are booming. But there you go. Prices, they are dipping ever so slightly. But they're still above the actual retail price in the shops. Now, speaking of aspirational luxury, this was a pressure point for LVMH. Sales declined in the second quarter, a sluggish economy, deteriorating issues, and I suppose deterring some of the shoppers from buying the higher-end products. That offset with the sales rebound in China. Let's get to our Bloomberg Opinion columnist, Andrea Felstead. Andrea, I love this. I mean, I'll get to the aspirational luxury person in a moment. I think I fall into that rather than true wealth. Is the luxury boom near an end?
It's not ending, but it does look like we are moving to perhaps a slower rate of growth, a more normal rate of growth after the very elevated levels of demand we've seen for the last 3 years as we came out of the pandemic. We perhaps couldn't travel as much as we wanted to, so we splurged on things like watches and handbags. Yep,
that revenge spending may well be coming to an end. I think that was the guidance, wasn't it, from the CFO there. But what do we learn more about the US and China? Maybe this is where the aspirational group come into play. I wonder what price aspirational shoppers run out of puff at. Is it a couple of thousand, 3,000, 4,000? I don't know. What is an aspirational shopper?
Aspirational, when it comes to handbags, aspirational is generally regarded as under $1,000. So that would be perhaps some, lower end Gucci, Burberry. They are certainly the brands that have been most affected by this. Many of the luxury brands have been elevating their prices, which in turn does take them out of the reach of some of these aspirational shoppers.
Yeah, well, Christian Dior managed to put on another 4% on prices just there in July. Andrea, thank you very much. Keeping it real for the aspirational shoppers and beyond. Andrea Felstead, our Bloomberg Opinion columnist, coming up in this show. NatWest CEO Alison Rose stepping down just hours after receiving a full confidence vote from the board. The controversy explained involving a politician turned pundit, Nigel Farage, and his exit from the private bank at NatWest, right here on Bloomberg. NatWest is falling this morning after the CEO, Alison Rose, stepped down following a row over the way the British lender closed Nigel Farage's bank account. Rose resigned after she admitted leaking information about the politician turned pundit to the BBC. The leak related to Farage's status as a customer of Coutts Bank, which caters to some of the UK's wealthiest people, including members of the royal family. Let's bring in our very own Will Shaw from the finance team. So this is a pretty damning moment for the bank in terms of, will CEOs want to talk to journalists ever again? Alison Rose has had to go. Was it political pressure that was brought to bear rather than the board?
It appears certainly that that was the case. And this looked, I think with hindsight, this now looks like it was inevitable that Alison Rose needed to go. However, it didn't look inevitable to NatWest until it was actually happening. So shortly after 5 yesterday, NatWest issued a statement in which Alison Rose was quoted. She admitted talking to a BBC journalist about the reason for Nigel Farage's account being closed. She apologised for that. She said at the time she believed that, yes, it had been done for commercial reasons, and she hadn't seen the internal documents from Coutts that suggested that Nigel Farage had been ditched because his values weren't compatible with those of the bank. The chairman of NatWest, Howard Davis, in the same statement, said, yes, there'd been an error of judgment, but the bank still had confidence in Alison Rose. Then everything went silent for a few hours, and at about 1:30 in the morning, London time last night, the story reopened. There was another statement from NatWest saying, in fact, Alison Rose will be leaving by mutual consent. Now, the political backdrop to this is obviously very important. As everybody knows, NatWest is still largely owned by the UK government. They have about 39% of voting rights in the bank. There are a lot of people within the government that share Farage's opinions and worldview. Now, people close to the Prime Minister and close to the Chancellor last night were briefing that Alison Rose's position wasn't sustainable and that she would need to go. So effectively, yes, it was an inevitable decision. It was influenced heavily by politics.
Well, the UK remains NatWest's biggest shareholder for about 15 years. I'm just looking at it here. So, of course, they will have a discourse, if not an influence. Do you think it's resolved the matter? Do you think we're going to have a committee hearing in Parliament? Do you think that they'll be called before Parliament to discuss this?
Well, Nigel Farage has certainly called for an inquiry in Parliament. I spoke to him this morning. As far as he's concerned, this matter isn't over. He would now like to see Coutts CEO Peter Flavel stepping down, and even Howard Davis, the chairman. He says he's written to Peter Flavel 3 times and received no answer. And on Howard Davis, he says Howard Davis is essentially responsible for governance at the bank, and the governance systems have failed. So I don't think that necessarily this is over at this stage.
I suppose then what next for the leadership? We have an interim CEO?
Yeah, so there is someone stepping in for 12 months to run the bank while they decide on a more permanent appointment. Separately, in light of this, the government has indicated that it will be pushing for reforms to prevent this from happening again. Even Rishi Sunak has weighed in. He said it's not appropriate for banks to be closing people's accounts simply for expressing their opinions within the confines of the law.
Okay, well, let's see where this rumbles on to. How many more scalps will there be had before this lies low? Will, thank you very much. Will Shaw in London. So the decline in Israeli assets continues. Investors' concerns grow over the law that weakens the power of judges, which has sent hundreds of thousands of people onto the streets. The Israeli stock market is on the move again today, recovering ever so slightly. You can see the stocks fell by 3.7% yesterday, rallying by 1.5% this morning. The dollar continues higher, the shekel lower. This will be the 5th day of a move like that for the shekel. So the pressure is coming to bear and yields tick slightly higher. Inflation could be the result of a weaker currency. That was one of the sentiments that came through from a conversation that we had here on Daybreak Middle East and Africa. I caught up with the former governor of the Bank of Israel, Karnat Flug. She's hopeful that strong market reaction may prompt the Netanyahu government to review its judicial overhaul plans.
I hope that maybe now with the very strong reaction of markets and of the streets, of the protests, maybe there will be a revision of thinking about what should be the next step. And I very much hope that any next step in the legislation will actually take all these very negative effects into account and will not move forward without a very broad agreement and a broader consensus that should underline any change, very fundamental changes in the system.
We had a guest yesterday that commented on Biden's intervention, late night intervention, the evening before this law was passed. And he said it's unusual for the US to comment on domestic internal events within Israel. Criticism is easy and fair, but not on domestic issues. When you look at this criticism from the US and other nations around the world, how deleterious is that to FDI, to global companies, global tech, saying Israel is hot on my list? Does it move off the hot list as a tech destination with this political shift at the moment?
Yeah, I think this is really one of the strongest channels by which this judicial overhaul is actually affecting the economy. We've seen a decline in the investment in the Israeli high-tech much beyond what happened in other high-tech sectors elsewhere. And we haven't seen the beginning of a recovery that we've seen elsewhere. I think the Israeli economy is more susceptible to this kind of changes because of its dependence on the high-tech sector that had been an extremely important engine of growth. It's a very important source of revenue, of tax revenue. It's more than half of our exports. And I think that's why we really have to be very careful in making steps that are causing concern among investors in actually investing in our high-tech sector.
That was the former governor of the Bank of Israel, Conor Fluke, speaking to myself and Yusuf Gamal Eldin a little bit earlier. She did warn a weaker currency delivers higher inflation. Higher inflation could undo all of the good work that the Central Bank of Israel has done and therefore could put rate hikes more materially back on the risk-ometer. Coming up in the show, it is Fed Day. We have a decision ahead of us today with guidance. The US is set to see the highest interest rates in 22 years. What will Jay Powell deliver in the narrative of forward guidance this evening?
Of the 90 largest economies on the planet, 60 are companies and 30 are countries. So does corporate world have something to do with it? Absolutely. And I think real leadership at the corporate level is a huge part of the solution. So I feel like part of my job is encouraging corporate leaders to make these investments. And it's not just sustainability, it's not just making sure that your footprint of your company is net zero. It's making additional contributions because biodiversity, there's no market for pandas or frogs, we still need to protect them.
Does climate change have a PR problem in 2023? Should we call it something else so that we act quicker?
I think so. I think climate change makes you think about something that's in the future, something that's polarized. What it really is, it's a carbon pollution problem. And we have an excess of carbon in the atmosphere and we need to get rid of it. That's simple as that. It's killing our children, it's killing the forests, it's killing the ocean.
And you can see the full interview with the photographer and conservationist Christina Mittermeier on Leaders with Lacqua Goes Green. That airs 9:30 p.m. New York time tonight in the US and 6:30 p.m. in London on Thursday. So are you ready? you ready for rates at a 22-year high? You haven't had much volatility getting there, really, have you? 4.85% is where we are on the 2-year. There will be no dots. There will be verbal guidance. The Philly Fed is flashing pay rises for all, my friends. The consumer is strong at a 2-year high, and the New York Fed is indicating the risk of a recession is at a 40-year high. What's not to love about Treasuries? How to protect yourself in the hubris of the debate about where the U.S. economy goes. What better lady to do it than Valerie Titel? She joins me now. Valerie, come on. Is it one more hike and done?
Look, Manus, that's the question everyone wants to know, but the problem is we're unlikely to get an answer tonight. It's upsetting, I know, Manus, but really I think Powell's going to keep his cards close to his chest. He has really nothing to gain from talking about a hike in the next meeting, or perhaps maybe conceding a big win on that inflation print 2 weeks ago. We've got a long stretch of time in between this meeting and the meeting in September. It includes 2 CPI prints and 2 NFP prints. He's really unlikely to give any strong guidance on what's to come. I want to go over this chart quickly because I think it's important. It goes over how the change, or how the front end pricing has changed recently. As you noted, Manus, we have had a lot of good economic data in the U.S., and that has seen the pricing for another hike creep up slowly. And it was that consumer confidence data yesterday we got, Manus, that showed consumer confidence rising to a 2-year high that is now putting the pricing for another hike post-July later in the year at 50%. This is going to be the key thing to watch. I think Powell's going to be pretty happy with this pricing. He definitely wants some positive term premium after this meeting. He wants that threat of additional hike to be taken seriously by the markets. And at the moment, it kind of is.
I actually walked past the New York Fed the other day in New York. I sort of walked past and went, oh, there it is. I venerated that rather than the consumer. Now, what else is going to shake the boat if Powell doesn't rock the boat tonight? What's on the horizon to shake the equity? Briefly, 30 seconds. Take it away.
It's not all just about the Fed. We've got a big slice of data coming this week. On Thursday, we get the first reading of the second quarter GDP. That's going to be one to watch alongside durable goods. Friday, PCE, the Fed's favorite measure of inflation, comes alongside the employment cost index, which is their also favorite measure of wage inflation. And then next Tuesday, we get the big ISM report, including manufacturing and services. Doesn't reflect the same picture as the PMIs, that manufacturing was rebounding. And this, again, maybe could push us to all-time highs. They are in sight, Manus. How exciting. The S&P 500 is now within 5% of those all-time highs from January 2022.
I'll leave you with this thought, Valerie. The higher that goes, the closer I am to sustaining that retirement fund. All eyes down. I've got a little bit breath left in me to go. I'll leave you with that thought. Surveillance. The early edition's up next with Aneeka Gupta in New York and Danny Berger in London. From Dubai, good morning, good evening.